All right. Welcome aboard, traders. This is Tyler Craig, Coach Tyler with Tackle Trading, coming at you with a special webinar on the power of put options. We're going to take a look at 3 different ways that we use put options over at Tackle Trading. So let me make sure I got YouTube up here. And we'll rock and roll. I'm excited about today. The timing is good. The timing is good. Market had a pretty big sell-off today. So one of the aspects of put options that we're going to talk about is how to use them to protect a portfolio. We're also going to get into how to use them to speculate. So protect, speculate, and generate cash flow. If you've never used a put option before, this will be a good webinar for you. I'm going to go through the basics of what is a put option, how does it work, and how do you use it to protect a position, again, how to speculate and generate leveraged returns, and then how to create cash flow. All right. Oh, there she is. There she is. All right, getting YouTube up here. All right, perfect. Got the chat window up. Dennis, what's up? Guitar Flip, hello. George Dragon, hello. Adib, welcome. Gino. All right. So I got the chat window. So as you guys have comments, questions, feel free to throw them in. Let us begin with the basics. I want to give you an introduction, an intro to put options. Okay, at Tackle Trading, we love to use put options in a variety of ways. They're not that complicated. They're one of the basic building blocks of the options market. And when you understand how they work, I think that you'll see that they can be quite powerful in enhancing your trading. All right. So first things first, you have 2 basic building blocks in the options market. You have call options and put options. Last week, Coach D talked about the power of leverage and call options. All right, so this is kind of a supplement to last week's discussion. You got the call option side of things last week. This week, we're going to talk about puts. And again, I think the timing is perfect here. The timing is fortuitous. If you take a look at the market, things are getting a little dicey. S&P was down almost 2.5% today. Tech stocks down 3%. 50-day moving average, they're turning into resistance. So, hey, who knows? Maybe this is a downtrend that will continue for a while. And in a situation like that, I can think of a lot of ways put options can enhance your trading. Okay, think of a lot of benefits to this. So let's begin. The basic definition of a put option. It is a contract. That gives you the right, but not the obligation, to sell shares of stock. Okay, so it's a contract that gives us the right to sell shares of stock at a specific price, which we call the strike price, on or before a specific date. All right, on or before a specific date. So if you got $100 stock and you want to lock in the right to sell that stock at $100 for the next 3 months, you could buy a 3-month 100 strike put option. Okay, so let's do that. Let's say that I either want to protect my position, maybe I want to speculate that it's going to go lower. We're not going to get to the cash flow component just yet, but for whatever reason, I want to buy this 100 strike put. And let's say it's $5. It costs me $5 per share to buy that put. Now, in the world of options, we sometimes talk about the price being per share. Okay. If you're talking per contract, we would say you're buying a $100 put at $500, right? That'd be if you're talking the total cost of the contract. Okay. So contract that gives you the right to sell a stock. So if you think about it, why would this be, I'm going to grab my tablet here. Why would this be something that you could use to protect a portfolio or to speculate that prices are going to go down? The answer is because as stock prices fall, puts go up in value. So unlike what you learned in last week's video, when you buy a put, it's a bearish trade. Okay, so one of the reasons why we like puts is it opens up the possibility to make money when prices fall. And it's pretty logical. If you have a $100 stock, okay, and you lock in the right to sell at that price, I have the right to sell at 100. Think about how valuable that is if the stock goes down to $90. So if the stock's at 90 bucks and you have the right to sell it at 100, that's a pretty valuable proposition, right? That's a valuable contract. And the lower the stock goes, the more valuable the right to sell it up at 100 becomes. Okay, so that means that put options rise in value. Okay, puts will go up in value as the stock price goes down in value. And again, that's because you've got the right to sell the stock at a set price. And that set price is going to be a premium to the current price if prices fall, right? And so the higher the price that you have the right to sell the stock, the more valuable your contract, okay? So puts go up in value as the stock goes down in value. That's the basic idea, okay? So how do I use that put option then? Again, you can use it to protect, you can use it to speculate, you can use it to generate cash flow. Let me get into the speculation part for a second. Do you think that put options made money today? Do you think that people that owned put options made money today? The answer is yes. Put options went up in value today. Quite a bit, actually. Quite a bit, actually. You get the NASDAQ down 3%, put options went up in value quite a bit. So if I owned a put option on my portfolio, or if I owned a put option on a particular stock, I just sort my watch list by percent change. Look at all the red here. Tesla was down 10%, right? DraftKings down 7%. Oil stocks taking it on the chin. Yeti down 5.5%. So a lot of stocks down over 5% today. That's a day where put options really pull their weight. So if you want to speculate that prices are going to fall further, if you want to enter a bear trade, you could buy a put option. Okay. So step one, when I'm using puts to speculate, is I got to find a bearish pattern. I got to find a bearish pattern. And for me, the two patterns that I like as a swing trader would be what we'll call a bear retracement and a bear breakout. So if I have a downtrend and we rally up a couple of days, maybe 3 or 4 or 5, and then the stock starts to roll over, I like that as a good opportunity to go bearish, to short. Okay, so selling rallies in a downtrend is known as a bear retracement. Okay, so every single week, every single weekend in particular, we put out a report that gives trade ideas for the week ahead, right? We scour the market. We say, we think these have interesting patterns that might trigger next week on the bull side and the bear side. And pretty much every single week, bear retracements are a part of that. Bear retracements are a part of that. So if I go back to last week's report, this most recent weekend here, we had, let me see, we had Valero. We had Valero on the bear report this weekend. Why? Well, it was in a downtrend. It had rallied up to resistance. This is what it looked like going into this week. Okay, downtrend, lower low, rallied up to resistance, even had an old support zone that was coming into play, descending 20-day moving average. So we said, okay, if the downtrend in energy continues, maybe I want to buy a put option on this thing. That'd be one way I could try to profit. So the stock was around 48 bucks at the time, 49 bucks. Okay, now it's at $44.50, right? So anybody who bought puts in Valero would be a pretty happy camper right now. Okay, how about the entire energy sector? That had a bear retracement coming into this week. Okay, overall downtrend, made a lower low, rallied up towards resistance. This one actually gapped right out of the gate on Monday. Had a pretty big down gap in energy, but even then it just kept going lower, right? Down 4.5% today. So those were a couple of the bear retracement patterns. Another setup I like to look for when I'm speculating with buying puts is a bear breakout. There's a lot of variations to this. You know, it could be a downtrend that's just kind of going sideways. We would call that a low base. Okay, I'd call that a low base. The opposite of a high base, you're just looking for this downtrend to break support and go lower, right? When it breaks support, maybe I buy a put option. That could be one way to capitalize on it. By the way, in case this wasn't obvious, buying puts is an alternative to shorting stock, right? So the long put here, the long put is a cheaper, limited risk alternative to shorting stocks. Like you can't short stocks in an IRA account. Can't do it in a retirement account. Sometimes the stock is hard to borrow. And when you short a stock, you're borrowing it from your broker and then you're selling it to somebody else. Sometimes the broker can't find shares to short. So they say, hey, sorry, Charlie, you can't short the thing. Well, if it's optionable, if it has liquid options, if it's got puts, then you could buy puts instead. And even if the stock is easy to borrow, shorting stock has unlimited risk. What if the stock gaps up 30% because it gets bought out or something? You might lose more than you planned on. So having a put that's limited in risk to what you paid up front is nice. If I paid $3 for a put, that's my maximum loss. If I paid $5, that's my maximum loss. So I don't have to worry about waking up the next day and, I don't know, seeing my stock gap up a lot, right? All right, so bearish pattern, you got a low base for a break of support. You could also see maybe a descending triangle at support. So that basically you've got equal lows and then you have lower swing highs. We call that a descending triangle. Descending, I don't want to spell triangle. All right, descending triangle. What else could you get? I don't know. There's a lot of variations, but basically you're looking for a downtrend that's got a key support zone. And that is another pattern we look for every single week. Okay, so let's see here. Okay, AIG is one. This is one that was on the report last week. So this was knocking on the door of support. Okay, knocking on the door of support and broke support this week. So there's a bear breakout. Bear breakout. How about Citigroup? Okay, coming into this week, Citigroup was in a downtrend. It had a big drop. It had gone sideways for 3, 4, 5 bars, just consolidating at the low. I'd call that kind of a low base. And then boom, fell out of bed on Monday, continuing lower today. Put options on that would be making money right now. Okay, how about Cisco? So Cisco, I think this was actually on the report 2 weeks ago, but also on the report this week, it was testing a support level coming into Monday. It broke support and continued lower, down 2.5% today. Long puts in all of those situations would have made some money. So step 1, find a bearish pattern. Step 2, pick a long put to purchase. So one of the things you've got to consider here is which strike price you want to buy. What strike price do you want to buy? If it's a short-term swing trade and you want to go a little more conservative, typically you buy in the money. So if you want to be conservative, by conservative, I mean that you have a little bit better probability. Stock doesn't have to move as much for you to break even. So what I would typically do is buy like an in the money, maybe an at the money option. Okay. If you want to go more aggressive, you have a lower probability of profit, but if you're right, you can make more money, get a better return. You might buy an out of the money option. Okay. In terms of time, I would usually just buy a couple of months. You're not going to buy a 6-month put if it's a short-term trade. You know what I mean? It's too expensive. It's too expensive. So let's see if I can pull one up here real quick. My game plan is to do 20 minutes on speculation, 20 minutes on protection, and 20 minutes on cash flow, showing you 3 different ways traders use put options to play. So somebody give me a stock that you think could be a candidate for a bear trade. Give me a stock you want to buy a put option on. Preferably not something that just got punched in the face. I don't want to chase, I don't want to short something that's already down a ton. I'd like to find something that is maybe just getting ready to break support or just now falling off of resistance. Like Valero already down 6%. I don't know if I want to chase that. Majid, you brave soul. You want to buy a put on Zoom? Well, you are picking the strongest stock in the entire stock market. And Zoom being a $500 stock, its puts are really, really expensive. This would be a gutsy play. I'm going to pass on Zoom. Little too, that one's tough for my blood. I like Boeing. Boeing's not too bad. That's potentially breaking support. I feel like some of these stocks that didn't get bid up with everybody else maybe won't get beat down as much. That might be a concern for me on Boeing. It hasn't gone anywhere for 4 months, so maybe there's not a lot of fluff built into its price. But I do like that breakdown setup, so we could consider that. Sienna, I wish I was already in on Sienna. I think we might have missed the ideal trigger on this one, but that one could be a candidate as well. Disney. Yeah, maybe Disney's going for a gap fill here. Maybe Disney goes for the gap fill from earnings. That could give you some opportunity. Yeah, these are all pretty good here. eBay. Ooh, okay, I like eBay. I like that's a nice little bear retracement there in eBay. I will say that the only thing that gives me pause on eBay is it did not fall with everything else. It's exhibiting a little bit of strength, at least over the last day or two. But if it rolls over like everything else, yeah, maybe it's a little bear retracement. So how would I build out a trade on this? I go to the trade tab. October, 3 weeks out. I don't know that gives me enough time. So probably thinking November, probably going out to November. It's a $50 stock. I don't know that I want to pay $6 for the in the money. I think I'd probably just buy the no 50, pay about $3.15. So if I bought that put for $3.15, my risk is what I paid. I'm going to look at the risk graph here. So my risk is going to be $3.15 and my reward is unlimited. Risk is $3.15. My reward is unlimited, at least until the stock hits 0, right? So you take a look at the chart. You say, all right, I think eBay could drop to $47. If it goes back down to its old swing low, it drops to 47. Well, what would your profit be if this thing went down to 47? It got there quickly. You're up $190, $190. Okay, what kind of an ROI is that? If you make $190 on $3.15, it's a 60% return. Now think about the leverage for a second. We're saying if a $50 stock, $50.68, if it goes down to 47, That's a $3.68 drop. Divide that by the current price, that's a 7% drop. So we're saying if the stock drops 7%, the put is going to go up in value 60%. 60%. So 7% drop in the stock, 60% increase in the put option. Is that leverage? Yeah, that's what leverage is, right? Small move in the stock, really, really big move in the put option. It's one of the reasons why people like to use options to speculate. Okay, so this thing drops to 47. I make a 60% return. Now that's assuming time doesn't pass. It's assuming volatility doesn't change. Okay, which usually time does pass. Usually volatility does change. So the results could be a little bit different, but I think that's a good forecast to kind of use just to gauge our expectations here. Okay. So there you go. There's buying a put 315, target 47. Now, could I put in a stop loss? I mean, maybe I don't want to risk $315. Maybe I put a 20-day moving average right around 53. You say, okay, well, if this goes back up after falling down, I want to get out around 53. Okay, you're risking $100 instead of 300. So just as you put in targets and stops for a stock trade, you can put in targets and stops for a put option. Okay, that is the general idea with using puts to speculate. Okay, I want to round out the note here and then be done. Okay, so for a swing trade, I'm looking to buy about 2 months. Okay, step 3, input the stop, maybe above resistance, and the target. Maybe that's the next support zone. If you're shorting it at resistance, it should fall down towards support. Okay, that's using puts to speculate. So in summary, anytime you find a nice bear pattern, low risk, high reward setup, you want to amp up the leverage a little bit, you want to make it cheaper than shorting the stock, you can buy puts. And where you get paid are days like today. Days like today, long puts really thrive. That's the first way you can use put options to speculate. Second way you can use put options is to protect. Let's talk about that for a second. In fact, let's talk about that for 20 minutes. All right, so this is like multifaceted here. This is why puts are so fantastic. There's lots of different ways you can use them. So puts as protection. Puts as protection. Well, number one, this assumes you have stocks or a stock portfolio that needs protecting. Okay, so now we're adding puts onto an existing position. We're adding a long put onto an existing position, such as long 100 shares of stock. So maybe I own 100 shares of the S&P 500. And I say, I'm uncomfortable with experiencing a bear market unprotected. I don't want to suffer through a 30% to 50% decline. So I'm going to buy a put option. And we're going to call it a protective put. Instead of what? Well, maybe you use a stop loss. I don't want to use a stop loss. Maybe this is a long-term position and I don't want to get shaken out. I just want to overlay insurance on top of my stock position. Okay, so the basic idea, A, you own shares of a stock. In this case, I'm using the S&P. B, I'm going to buy one put option because it gives me the right to sell 100 shares. So one put, you buy one put option and it gives you the right to sell 100 shares. If you owned 200 shares, you'd buy 2 put options. Okay. Now, what does that do to your position? Yeah, the stock could gap as well, Ahmad, and that's where stop losses also don't really help. Okay, so stop losses give you protection, but it's not ironclad protection. It doesn't protect you from a down gap. That's a good point. So let's model this here, okay? And actually, I want to, in general, we usually buy out of the money puts because they're cheaper when we're buying insurance. And then you usually buy enough time to be protected for as long as you want. So if you just say, hey, there's an earnings announcement tomorrow and I just want to be protected for the next week, you don't need to buy a 1-year put option, right? Maybe you buy a 1-month put option or a 2-week put option. You buy short term. But if you say, hey, I want to own these puts for the foreseeable future, I don't want to keep having to buy more puts every week. That gets expensive. I don't want to buy 12 1-month puts over the next year. I'd rather buy one 12-month put. So you have to think about, like, why am I buying this insurance? For how long do I want to be protected? If it's to protect forever, then, you know, I'd be buying long-term insurance. Okay. So buy enough time to be protected for as long as you want. So let's see what impact this has on a risk graph. Okay. So I'm going to draw a picture here. Risk graphs are wonderful. If you've never used a risk graph, this is part of what we teach in our option courses at Tackle Trading. But the idea with a risk graph is just to give you a picture, a visual of your potential profit and your potential loss. So if you were to model the risk graph of a stock position, it would look like this. It's the 45-degree line. And the way it works is that horizontal line is break even or zero. Above that, you're making a profit. Okay, so this up here is the profit zone. And below zero, of course, would be the loss zone. Okay, and then the stock, you know, going right would mean the stock is going up in price. So maybe it's a $100 stock. Here, you know, it's $150. If you're going left on the diagram, that's the stock price getting cheaper. Okay. So the yellow line is the actual risk graph. So if you bought the stock for $100, 100 would be your break even. And then as soon as the stock starts rising, you start making money. The reason everybody likes to buy stock, at least one reason, is because you have unlimited upside. You have unlimited upside. Okay. And stocks really don't have an upper limit. They can go up to infinity. Okay, and then they split and go to infinity again and split and go to infinity again. And go look at a super long-term chart of the stock market. They tend to keep going up. That's why we like them. The reason we don't like owning stock is because you also suffer all the downside, right? So when we have a March where asset prices fall 30%, the last couple of weeks have not been so fun. So volatility, or these downturns in prices, is the price you pay for those gains. And some people don't like that. This is the scary part, the part that makes it hard to stick with stocks and get the long-term gains. So what if I can come in here, because see, my downside is open-ended. I keep losing as low as the stock goes. What if I can come in here and I can create a graph that looks more like this? Wait for it. Right there. What if I can create a graph that looks more like this? I can say, okay, I'm going to lose money if it goes from 100 down to 90. But once it hits 90, I can't lose anymore. What can I do to turn this 45-degree line risk graph into more of, you know, a hockey stick? Well, you just add a put. You just add a put. So you just buy a put option. If you want to turn the long stock risk graph into limited risk, unlimited reward, just add a put. Add a put option. And it turns your long stock into this type of graph. Okay, whether it's a stock portfolio with lots of different shares of stocks or different companies, whether it's a single stock position, you add a put and it turns it into limited risk. Okay, so what does that look like? Well, you give me a stock that maybe you want to just, I don't care. Give me a stock you want to see me buy a put option on to see what it would do to the risk graph. I could do it on the S&P, but I enjoy a little bit of participation. So what's the ticker symbol? What do we want to illustrate buying a put option on? I'm going to show you the before and the after. I'm going to show you the before and the after. Yeah, you do have to pay for the put. That's for darn sure. There is an insurance premium. There's a cost associated with it, no doubt about it. And that is the trade-off, right? That is the trade-off. All right, let's do Apple. And I'm not necessarily giving advice to go buy puts right now, right? Obviously, the market's dropped a lot. I mean, in hindsight, you should have bought a put 2 weeks ago. But I want you to understand the concept and to see how it impacts the position. We can talk more about timing a little bit later. So if I buy 100 shares of Apple, click on the ask price, buy 100 shares Apple, say I'm getting it. So, all right, Apple closed at 107. It's down at 105.85. So stocks have continued to sell off after hours, it looks like. If I right click and analyze this, here you go. Here you go. So this is the risk graph of a long stock position. We love it because if the Apple goes up over time, we make lots and lots of money. We don't like it if Apple goes down, you know, we lose money. So this is the part of the risk graph that's a little spooky, okay, that creates some uncertainty. Well, if I wanted to buy some protection, what would I do? Well, Apple's at 107. If I bought a put that was 10% out of the money, it's going to be a little bit cheaper. It's going to be a little bit cheaper. And so let's model maybe buying like a 95 put. Okay, maybe a 95 put. So let's take a look. How many months should I buy? I don't know. I mean, look, if this is a long-term position and you want insurance for the foreseeable future, I'd probably buy out, pretty far in time, maybe 6 months, maybe a year. If you say, well, I just want to own insurance for the next couple of weeks, I don't think you need to go out and buy 6 months. In this case, I'm going to go out to April of next year. I'm going to go down to that 95 strike. It's going to cost me about $800 to buy this put option. Now think about that for a second. I have a $1,000 or $107 stock. We're actually calling it 105.85. Take that times 100. So you got $10,585 in a stock position. They're charging you $800 for the put. $800 divided by your 1085. Oops, too many zeros. 800 over 10,850. No, 105.85. About 7.5% would be the cost of the insurance out to April. So it's not free. I mean, there's a cost associated with it, to be sure. In this case, 7.5%. Now, is it usually 7.5% to buy a 200-day, 10% out of the money put? Depends. I mean, right now, options have gotten more expensive. If you wait until the market sells off, you know, like looking at Apple, how far has Apple dropped from its peak? Peaked right around 138. So 105.85. It's down $32 divided by 138. Is that right? I think I did that wrong. 138 minus 105.85 divided by 138, 23%. Look, if you wait for your stock to drop 23% and then you buy puts, yeah, they're going to be expensive. Number one, because prices just dropped a bunch. Number two, implied volatility will be higher. So puts get expensive. Puts get expensive after big sell-offs. So the sarcastic answer is you buy a put before the sell-off. Okay, the reason it's sarcasm is you don't know when the sell-off is going to come. So, you're not going to find a perfect rule or a perfect guideline for how to get you in a put at the peak. It's just not going to happen. But that is why the point here. That is why Apple puts look kind of expensive. Yeah, I mean, it just dropped 23%. So everybody's panicking and buying puts now, and typically you want to already be in. But what's this going to do to the risk graph? If I buy this put around $8, right click and analyze, look what it does to my risk. So here's the before. You have open-ended risk, and I don't think Apple's going to go down to 0. Okay. But let's model something that could realistically happen. Let's say Apple goes back to $70, 50% decline. Okay. In March, I guess it didn't even go down. 50% might be a bit much. Let's say $85. Let's say $85. So you drop to 85. Come in here and you say, all right, if this thing goes down to 85 without any protection, down another $2,000. If I owned insurance and it drops to 85, I'm down $1,100. Okay, so cuts my loss almost in half on a drop to 85. Cuts my loss almost in half. Now, if you really want to make buying protective puts look super sexy, you could model like a down 80% move, and the difference between the two is insane. Like you get killed with long stock. With a protective put, you lose way less. But I think it's kind of silly to model a down 60, 70% move, because those really don't happen that much. A little more realistic if you model like down 20, down 30. I mean, heck, Apple just went down 23% over the last couple of weeks. So obviously it's got it in its DNA. It can do it, right? It can do it. Okay, so I mean, there's an example of shifting my risk, and indeed, I don't want to say eliminating, but certainly reducing or limiting the downside by buying a put option. Now, the reality is we are opening Pandora's box a little bit, right? Just by introducing the concept of coming in and modifying a stock position by buying a put option, now this brings up all sorts of questions. Okay, when do I buy the put? What do I do if the stock goes down? What do I do if the stock goes up? Right? Now you have all these dominoes with this decision. Management, how do you manage the thing? Anybody can go in and buy a protective put, but knowing exactly how to manage it is really going to be the key. And that's more than I can do in a 20-minute introduction to buying puts. I would add that you can do this for an entire portfolio as well. You can do it for an entire portfolio as well. So, this risk graph could be my entire portfolio. Maybe I own tons of shares of different stocks and I've got open-ended risk. Well, I can buy puts on the S&P 500 or some index to hedge my investment. And if the market goes down, I have limited risk. And I will tell you, when you know what your risk is, it really makes it easy not to panic into a downturn, because what happens, when stuff gets nasty like this is you start to like blow things out of proportion. You're like, oh my gosh, Apple's down 23%. Next week, it could be down 50%, and it's going to be down 80%. And, your imagination goes wild, and you start to be fearful, and you talk yourself into puking up your stocks when they're down, 20, 30, 40%, which in the long run is not a good idea, right? But if you said, hey, I know how much is at risk. I put $10,000 in. I have 1,500 at risk because I'm protected. Okay, then you know what your risk is. You've defined it. You know how painful it can get. You've accepted that. And so your tendency to panic is really nil, because you've already kind of internalized it. It's when the risk is a question mark that things get challenging, that it becomes hard to stick with a long-term stock position, because in your mind, you just have this question mark and you're like, well, is this going to be March again? Is this going to be 2008 again? How bad's it going to get? I don't know. And then, pretty soon it's down 30%, you panic and sell it. And 2 years later, it's, you would have made all your money back and then some, right? So that's another psychological benefit of adding puts, is it defines your risk, puts a number on it, so you can sleep easy knowing how much exposure you have going into each and every sell-off. To be fair, the counter is, well, you got to pay for that put. And what happens if you don't end up needing it? Did you just take $800 and throw it down the drain because you bought insurance you didn't need? In some cases, yes. And so that's where it goes into, how do you reduce the cost of the protective put? Are there things you can do to help finance the purchase of the insurance? Maybe you do a put spread, which is cheaper, right? Like, for example, with Apple, I bought a 95 put. Even if I came in and sold like a 60 put against it, I might say, look, I don't think this is going to go below 60. They'll pay me $100. I can reduce the cost of the insurance by $100. That's not nothing, just by selling a way out of the money put. So there are ways that you can try to reduce the insurance costs. But step one is you got to get the basic idea of what happens when you buy a put on a stock position. Okay. Final word, and then we're getting into cash flow. I think a common mistake that people make with insurance is they don't care about it at all when the market's fine. They don't think about it. Out of sight, out of mind. They say, Apple's going up every day. What do I care? It's almost like it hasn't rained forever. So you're like, I don't need an umbrella. It's not going to rain anymore. And the moment you really forget the umbrella, it starts raining, right? And maybe it's hailing, and because the stock market going down is certainly more hurtful than you getting rained on. Maybe it's hailing golf balls and it could kill you. You're like, I need an umbrella. It was out of sight, out of mind. I didn't think about it. And now you're thinking about it. Now, you're down 20, 30%. You're like, maybe I should buy insurance. It's like, well, you should think about that before we go down 20, 30%. You should think about that. So markets will move in cycles. They always do. Okay. And if you think, I'm screwed, I didn't think about it. Well, guess what? We'll recover from this at some point. We'll have another glorious bull market. You'll get lulled into a false sense of security, and then they'll pull the rug out from under you again, and we'll have another downturn. So you'll always have more chances in the future to apply this. All right. So yeah, Jose, you could sell short-term puts against it. Yes. You could sell covered calls against your stock position. You could do just a bear put instead of a long put. Those are the types of things that I would experiment with in trying to reduce the cost of puts. Okay. All right. Are we warming up to put options? These are so great. They're so great. Okay. If this was a dating profile and these were the characteristics of a put, I'd be interested. I mean, I don't know how you get dates. I've been married for too long. I don't know what the lingo is, but I would let the put know I'm interested. Okay. Color me impressed, Mr. Put Option, or Mrs. Put Option. Okay. Me like you. And they even have one more feature that might interest you. You might say, speculation, screw it. I don't even care. Protection, boo, who needs that? Cash flow. Okay, now you're talking my language. Let's chat, right? How do you use put options to generate cash flow? Well, interesting you should ask. If you think buying puts is dumb, how about you sell them? Puts how do I want to do this? Let me just say cash flow. Cash flow. Okay, so this little strategy is known as a naked put. Okay, a naked put. So you are selling put options. You are selling insurance. You are Geico. You are Allstate, Farmers. If you don't want to be the one to buy the insurance, whether to protect your portfolio or you're buying insurance because you want to profit from it because you're speculating stocks are going to burn down. If you don't like those two ideas, then how about selling the insurance to get paid some premium? Okay, the silver lining of this crash, I don't want to call it a crash, of this correction is insurance premiums are rising. So the payday for those willing to sell puts has increased. So when you sell a put, what does that mean? Basically, you're obligating yourself to buy stock. Okay. And you can treat this as a trade where you just get in and out, or you can treat this as the potential entry into an investment where you sell puts on a stock you wouldn't mind owning. You wouldn't mind owning. So give me a stock where 3 weeks ago you would have said, you know, I missed it. I hope this stock pulls back so I can get in at a better price. Just off the top of your head, give me a ticker symbol where you were kicking yourself 3 weeks ago. Maybe you own it, but you want to own more. Maybe you don't own it, but you wish you did. And let's see if we can get paid for our willingness to purchase the stock. We could use Apple. I mean, I've been looking at Apple today, but we could look at something else. Okay, GDX. So gold and silver is a little bit different because they have kind of a theoretical floor, but you could certainly look at those two. You got to be willing to buy 100 shares too. So the challenge with Tesla is you got to be willing to put 30 to 40,000 bucks in it. So that might price out some listeners here. Nike. Well, the problem with Nike is it hasn't gone down. So it doesn't fit my narrative. I need a stock that's gotten beaten up recently. Zoom doesn't fit the narrative either. It's already gone up too much. Facebook could work. DraftKings, unfortunately, I would like DraftKings to come down a few more bars. It's not that oversold. Coca-Cola, yeah, we could do something on Coca-Cola. Hasn't got beat up too much though. Microsoft, yep, Microsoft could work too. See if there's any others here. Let me go with Microsoft. Okay, let me go with Microsoft. All right, so this guy's been beaten up a little bit. What is the correction number here? 230, 286 minus 259. Okay, we're down 14%. We're down 14% in Microsoft. All right, I mean, you're getting a bit of a discount there. Maybe it goes lower, I don't know. But if you look at the implied volatility in Microsoft, okay. I'll tell you one reason why I'm not as excited on this second phase of the NASDAQ sell-off. You know, the first phase of the NASDAQ sell-off, you had a much bigger spike in implied volatility. This phase, they're just kind of like, There's not as much urgency, it seems, in people running out and buying puts. I'm using Microsoft as my proxy for the NASDAQ. That's unfortunate because if there was a little bit more fear baked in this, you'd get more payment. You'd get paid more selling puts in these guys. Okay, but nonetheless, let's say that I'm willing to buy Microsoft at 190 or 185 or 180. You pick the price you're willing to buy it at, and you could sell a put. So normally we sell short-term options so that there's not a ton of time that we're exposed, and it takes advantage of the higher rate of time decay. But as I look here, the 190 put, they'll pay you 345 bucks. They'll pay you $345 for that. That's not bad. Say, all right, I'm willing to buy it at 190 for the next 3 weeks. They'll pay you $345. If it stays above 190, you'll make 345 bucks. If it's below 190, you get to buy it at 190, but you keep the $3.45. So your true purchase price, your cost basis would be 190 minus 345, which puts you to about 186 and change. Okay. So best case, you make $345. Worst case, you're long 100 shares of Microsoft at 186.5. 186.5 off of the high. You're getting it 18% off the high. Okay, 18% off the high. That's pretty compelling, right? Pretty compelling for me. So in timing it, you're trying to pick the bottom. I mean, if this thing keeps going lower, then you can sell much further out of the money puts. So this is a bullish trade. So in timing when to sell a put, you'd like to be as close as you can to the pivot low, right? Okay, so that's what Microsoft looks like, picking an October 190 put. There is your payday, but you got to be willing to buy the stock and or make sure that you get out if it goes too far against you. Like in this case, if I model out the risk graph, this is what a naked put looks like. Selling a put option. You're the insurance company. This thing goes down to 190 and you exit, you're down about $380. It's not terrible. If you say, hey, I'm going to get out at 380, sorry, 190 bucks. You're risking 380, your reward's 345. It's about 1-to-1. Risking 1 to make 1. It's not terrible on a naked put trade. That's the other thing that's nice when stocks get oversold and volatility's high, your risk reward on a naked put is also more attractive. The risk versus reward isn't as lopsided as it usually is, right? So that's Microsoft. Nikola is, I mean, this one would certainly be one of the riskier ones, right? So I feel a little more comfortable selling puts on something that isn't so nuts, right? This is definitely on the higher risk, higher reward end of the spectrum. So I'm sure the out of the money puts look very tempting on this, but there's no free lunch. So the reason they look tempting is because people think there's a chance Nikola could get down to 10 or 5 in the next couple of weeks. So buyer beware on that. But yeah, I'm sure it's pretty tempting. What was the other one? Disney. Yeah, Disney down 3% today. So this guy's coming back, and I don't mind this. I wouldn't mind a pullback in Disney. Sure, smack it down to 100. Great. Yeah, fine. Is the implied volatility going up? A little bit. Not a lot of fear yet coming into Disney. If the implied volatility went up more, it'd be increasing the value of the puts a little bit more. So could see a gap fill here. That would also give you a better entry point. So I don't know if I like the entry right here, but let's see what we can get. If I go sell a put down at 118, get 200 bucks. If you're assigned, you're long the stock at 116. It's not that great, actually. I don't know that I'm as, Disney is not as potent an example of getting paid a lot selling out of the money puts. They don't seem to think Disney's going to get crushed. There's certainly not a lot of demand for out of the money puts. So obviously, you know, it's still legit. You can still do it, but there's not a, this is like the opposite of Nicola. Nicola lets you go to zero and sell puts. Disney, not as much, right? Not as much. All right, let me see if I can find one more though. So some of these that you guys are bringing up might not be as liquid. These are newer, like SHLL. I've never even heard of that company. I don't even know if they have liquid options. Yeah, the options are not liquid on SHLL, so that would have to be a stock play. CWH, Camping World. Boy, that chart looks ominous. Looks like Camping World's getting ready to break down. The reason I like something like an Apple as just more compelling is I like something where the rubber band is stretched a little more, and I have a little more confidence that it's going to pop back, right? If it's just kind of like Camping World, I mean, Camping World's just kind of gone sideways, and which is fine. It's just, it's not as compelling of an entry point if I'm going to sell puts, right? So all right, guys, one sec. My little rugrat came in here. All right, friends, sorry about that. So again, I like let's see, Kroger is up 4 or 5 days in a row. That looks like a bear retracement. That one looks like a good short to me. That one looks like a good short. Yep. Ahmad, I just kicked him out. I just kicked him out. He does. That's because that's his first kid, Ahmad. Cody brings his kid. It's his first one. He, you know, he's like I was when I had my first kid. You're just proud papa, right? You get to your fourth kid like me, and I'm like, they're just little rugrats. Get out of here, you know? I'm just kidding. Albemarle. So here's the other thing. It's got to be a company that I'm willing to own. I much prefer that, right? Company that I'm willing to own. I don't know anything about Albemarle, but I know something down 15% in one day kind of scares me a little bit. I want to see it. Pivot and turn higher. I'll do one other one on silver, then I'm going to bounce. Okay. Silver makes me a little bit nervous. The speed of this descent is pretty breathtaking. Down another 7%. What's troublesome about silver is it went straight up when it broke 18 bucks, and there's just not much by way of support, right? And so it's like, well, are they going to form a new support level, or are we going to completely retrace the breakout over 18? And there's still $3 that it could fill before it finds like old major support. So, you know, here's the longer term chart of silver to see what I'm talking about. So that one made me a little bit nervous, but yeah, I mean, naked puts could be one way that you consider trying to fish for a bottom. So if you take a look at the out of the money puts for silver, again, trying to generate some cash flow. Honestly, for October, 1850 is about as good as you're going to get. 1850 or 19 strike. You sell the 19, I mean, crap, we were almost down $2 today. You get another day like today and you're down at 19, right? So it doesn't feel that far out of the money based on the last 3 days, but you're getting 31 bucks. They're making you put up 267 to do it. It's over a 10% return, maybe a 13, 14% return. It's not bad. You're betting it's going to stay above 19. I mean, your ability to pick the bottom in silver is probably as good as mine. Okay, so I don't really have any insight in terms of the timing. The thing that just makes me a little bit nervous is you got so much room until there's any prior support zones. So something to think about. But yeah, I mean, that's a way to use puts to cash flow. One sec. All right, so well, Tom, just because I wouldn't sell put, just because I wouldn't sell a put, or just because it's so doesn't mean I would necessarily want to buy a put. I mean, if you think about it, silver is down in 3 days. How much? It's down $4. It was at 25 bucks. Silver's down 16% in 3 sessions, and now I want to buy a put. Like, what's the risk reward? You got to make the case that this is a compelling risk reward for a new bear trade to speculate on the downside. I mean, maybe it ends up working. I'm usually not a fan of going bearish after that big of a drop myself. Okay. Skyla, in terms of the naked put, yeah, the basic idea is I sell a short-term out of the money put option, 1 contract per 100 shares I'm willing to buy. So real quick, one more time, if I take a look at, let me just look at my watch list to see who I like here. Yeah, it did break the 50-day moving average, Ahmad, but the 50-day moving average was at $24. It's at 21 now. So you got to be talking to me when it's breaking the 50. You can't wait for it to drop $2. It's down 10% after that, right? So that doesn't hold for me. Trying to see here. Okay, what about something like Pinterest or Twitter? Something that's been going up while the market's been going down. That would be an alternate way of playing this with like a, playing just a pullback on a strong stock versus looking for something that just got the snot kicked out of it, right? But let's use, I'm actually going to go back to Apple for a second. Okay, so let's say I want to buy 100 shares of Apple, and I'm looking at this pullback opportunistically, and I'm like, all right, I'm willing to buy Apple at lower prices. So I go out to October, I come down to 100, I can get 250 bucks. So I'm selling an October 18 Delta put for 250 bucks. So you just click on the bid price of the put you want to sell. It's a short-term, out-of-the-money put, 254 bucks. And if I hit confirm and send, the margin requirement is 1552. 1552. So let's see. If I make 254 bucks on 1552, that's about a 16% return on the initial margin. Or this is the collateral you have to put up to do it. Now, if you end up buying the stock, you got to have the 10,000 bucks to buy it at 100, right? But they don't make you put up the whole 10,000 bucks initially. Account. So, okay. So bottom line on the Apple trade, I don't think that's, the numbers aren't terrible. Now the timing, I don't know. I mean, if Apple's down for 5 more days, you might as well wait, right? So if we gap lower tomorrow and it just keeps getting pummeled, you do the best you can to try to buy the dip, right? And get in close to the low. Maybe we're talking about selling 90 puts on this thing. I don't know. It's just at some point, I don't think Apple's going to go to 0. And so at some point, this dip is a buy, but you want to wait for the chart to kind of give you a compelling reason. So, and I brought this up in the halftime report. Apple has been good for bounces along the way. but it's paid to wait for it to get kind of oversold and play it into weakness versus chasing it into strength. And that actually would be the thing that I would suggest with naked puts in a downtrend. You want to, sell puts into weakness, not wait for 3 big up days and then sell them. Like, because a lot of these are in downtrends now, you got to be quick on the trigger and do it at support, not chase stuff into strength. Okay. So, all right. So anyways, on the order again, I just found the October out of the money and clicked on the bid price to sell it. Okay. So that would be an example of the entry price. We talk about naked puts again all the time in our traders lounges and other, cash flow clubs and such. Main purpose tonight was to give you guys a quick introduction to put options, using them to protect, using them to speculate, using them to potentially generate cash flow. There's a lot of things you can do with a put option. A lot of things you can do with a put option. So which one appeals to you is going to depend a lot on where you're at in your trading. If you like directional trades and you want to add some bearish stuff to your playbook, you're going to like buying puts to speculate. If you own a lot of stocks and you like the idea of buying insurance, you're going to like buying puts to protect. If you don't own stocks and you don't like doing directional trades, you like doing more positive theta, high probability cash flow plays, you're going to like the naked put. The fascinating thing is this is all just one instrument. And yet, because it's multifaceted, you can use the put to do a variety of things. And so really everybody should be able to find something they like about using put options. Okay. All right. If you like this, if you want more, come join us over at Tackle Trading. And we do this every day. We do this every day. I appreciate you guys hanging out with me tonight. If you have comments, queries, etc., you can email us, team@tackletrading.com, or join one of the other sessions. All right. Okay. If I missed any other questions, I apologize. Joe, I will give you my watch list here real quick. Yeah. So if you want, this is the link. So you'll take this link. Oh crap! It won't let me do it. I got to sign in. I'll bring it up on my screen. Okay. I'm bringing it up on my screen. There's the code. All right. If you can just screenshot or jot that down, that's the one that you want to put in the setup and open shared item. But that's the toss link for my liquid stock watch list. All right. Okay. Thanks for hanging out, guys. We'll see you next time.